Recognize the types of exempt issues, exempt issuers, and exempt transactions. When securities are required to be registered in order to be sold to the public, they are known as non-exempt securities, not exempt from registration and must be registered. However, there are exemptions from the registration requirements, which we will discuss now. Exempt issuers: certain securities are exempt from the registration and prospectus requirements of the Securities Act of 1933 because the issuer is the federal government, an agency of the federal government, or a municipal government, or because another government regulatory agency has jurisdiction over the issuer. These exempt issuers include the U.S. government, municipalities, national and state banks but not bank holding companies, building and loans and savings and loans S&Als, charitable, religious, educational, and non-profit associations, and common carriers, for example, railroad equipment trust certificates. Test topic alert: the bank exemption applies only to the securities of banks, not to the securities of bank holding companies. Securities issued by the First National Bank of Bigtown, for example, common shares of the bank are exempt. But the bank is owned by the Bigtown Bank Holding Company, Inc., and the holding company's securities are not exempt. Exempt issues: certain issues securities are exempt from the registration statement and prospectus requirements of the Securities Act of 1933. There are several such exemptions. The two exemptions that appear on the exam are commercial paper, bankers' acceptances, and other securities that have maturities of 270 days or less, and insurance policies and fixed annuity contracts but not variable annuities. Take note, insurance policies are not included in the definition of security. However, variable annuities, variable life insurance, and variable universal life insurance are funded by separate accounts that are invested in securities. Therefore, these products must be registered as securities with the SEC. For the exam, if you see the word variable or the phrase separate account product, the product must be registered. Exempt transactions: some securities are exempt from registration requirements due to the nature of the transaction. Often these are smaller offerings or have restrictions on who may invest. Regulation: small and medium-sized offerings. With the passage of the Jobs Act, a rule was put into place that would ease the requirements for small and medium-sized companies to raise capital. Regulation provides to offering tiers for small and medium-sized companies that allow the companies to raise capital in amounts substantially more than the $5 million previously allowed under this rule. Tier 1. Securities offerings up to $20 million in a 12-month period will be allowed in Tier 1. Of the $20 million, no more than $6 million can be sold on behalf of existing selling shareholders, similar to a combination offering covered earlier. The offering would be subject to a coordinated review by individual states and the SEC. Tier 2. Securities offerings up to $75 million in a 12-month period will be allowed in Tier 2. Of the $75 million, no more than $22.5 million can be sold on behalf of existing selling shareholders. These offerings are subject to SEC review only and none at the state level. Tier 2 offerings are still subject to rigorous disclosure requirements to the SEC, including audited financial statements and annual, semi-annual, and current reports. Offerings under both tiers are open to the public, and general solicitation advertising is permitted for both tiers. However, Tier 2 investors must be qualified investors, and there are two ways to qualify. Be an accredited investor as defined in Rule 501 of Regulation D. Limit the investment to a maximum of the greater of 10% of the investor's net worth or 10% of the investor's net income per offering. Note that self-certification for Tier 2 as to net worth and income is all that is required with no burdensome filings. Tier 1 has no investment limits. Finally, remembering that regulation is intended for small and medium-sized companies, the regulation specifically excludes investment companies, i.e., private equity funds, venture capital funds, and hedge funds. Rule 147, the Intrastate Offering Rule. Under Rule 147, offerings that take place entirely in one state are exempt from registration when the issuer has its principal office headquarters in the state and all purchasers are residents of the state. In addition, the company must meet one of the following criteria. It receives at least 80% of its income in the state. At least 80% of the issuer's assets are located within the state. At least 80% of the offering proceeds are used within the state. The majority of the company's employees work in the state. Also, if there is a BD acting as underwriter, the BD must be based in the state. Securities sold under Rule 147 may not be resold to non-residents of the state for 6 months after the initial purchase. Regulation D. Exempt Transactions Private Placements. Under Rule 506B, the SEC does not require registration of an offering under Regulation D as long as there are no more than 35 non-accredited investors. There is no limit to the number of accredited investors that may invest in the private placement. Purchasers in private placements must have access to the same type of information they would receive if the securities were being sold under prospectus in a registered offering. The amount of capital that can be raised is unlimited. A private placement investor must sign a letter stating that they intend to hold the stock for investment purposes only. Private placement stock is called lettered stock due to this investment letter. The certificate may bear a legend indicating that it cannot be transferred without registration or exemption. Therefore, private placement stock is also called legend stock. The SEC requires that all companies raising capital in a non-public offering that qualify under the Regulation D exemption file the information on Form D online. The SEC also specifies the instances when an amended Form D must be filed, such as to correct a mistake of fact or an error or to reflect a change in information.
General solicitations and advertising private placements under Rule 506C. In order to solicit or advertise exempt securities offerings private placements, a business will need to meet certain requirements regarding the intended investors. First, meeting the requirements assumes that the securities are in fact being offered under the Regulation D registration exemption. Beyond that assumption, the requirements are as follows. All purchasers of the advertised securities must be accredited investors, or the business must reasonably believe that the investors are accredited investors at the time of the sale. In other words, while businesses may sell to up to 35 non-accredited investors, in order to solicit or advertise, all purchasers must be accredited. The business must take reasonable steps to verify that all purchasers are accredited, considering background, relevant facts such as reported income, and particular circumstances of each purchaser. Test topic alert. Sometimes it is difficult to identify private placement stock in a question because of the many terms that can be used to describe it. Recognize that all of the following terms are synonymous with private placement stock: restricted because it must be held for a 6-month period, and registered. No registration statement on file with the SEC. Letter stock investor agreed to terms by signing an investment letter. Legend stock. A special inscription on the stock certificate indicates restricted transfer. Take note. Other disclosure documents. Municipal securities. The primary disclosure document for a municipal security is the official statement. It contains much of the same sort of information you would find in a prospectus. Private placements, regulation, and other exempt securities. The common term for the disclosure document for other types of exempt securities is the offering circular. Sometimes the term notice of sale is used. This document is very similar to a prospectus, but is often not as detailed in its disclosures.